So welcome to my full course on trading my exact strategy. But before we get started in going actually into strategy and the confluences, the most important thing in my opinion about trading is actually understanding why you are trading in the way you are. So the whole point of this small subsection of how my strategy works is just to explain to you how it works so you can understand why we're trading in the way we are, because it allows you to, instead of just following rules and understanding, oh look, Ralph just waits for a change of character and the fair value gap retests and enters, let me just wait for that. It allows you to actually think outside the box on the market and actually understand why he is trading in the way he is, so that you can understand why you're trading in that way as well. So the most important thing about trading a strategy is actually understanding how it works. So my strategy, and if you've been following me for a long time, you know it is a scalping strategy. So we're trading on the lower time frames like the 1 minute or the 5 minute. Now, when you trade scalping, you obviously need to see big and high volume moves because you only want to be in your trade for 30 minutes or so. And if you're targeting, let's say, a 1 to 3 or a 1 to 4 risk to reward ratio, you kind of don't want to be in that trade for too long. And a 1 to 4 is actually quite a big distance to trade for because it means you have to win 4 times more than your risk. So if you're risking 10 pips, you've got to make 40 pips and just stuff like that. So obviously, you need to be trading with the high volume. So how do we get high volume, and how do we always ensure that the trades we're going to take have a lot of volume so they move quite fast with a lot of pips, so we don't actually have to be in our trades for that long? Well, how we do that is we trade manipulation. Now, manipulation is basically where the higher powers in the market, the industries, the banks, the people with a lot of money who fuel the markets, are also trading at the same time. Because if we're not trading with them, we're not going to catch the volume, because if they're not trading, then there's no volume in the market. And when they are trading, there is volume in the market. So obviously, we need to be trading with the banks. Now, obviously, you can't just call up like JP Morgan or HSBC and ask, oh, are you trading today? Obviously, we can't do that. So how do we have to figure out that they're trading is by using key signatures in the market that these banks and industries leave behind. So when you look at a market and you analyze the market, there are some areas in price where you can see that the banks have been trading, or also that the banks could be trading. Now, obviously, banks are trading all the time. The market is fueled by these big industries, but they're always just placing small orders, either in small consolidation. Let's say if you have a look at Asia session, price is usually moving quite slowly. We're not talking about that type of bank movement. We're talking about the big banks candles. So let's say when you see the New York session open, the candles move fast, up, down, up, uptrend, downtrend, high volume. We're talking about that kind of bank order flow. So one of these key areas and signatures that these banks leave are called liquidity sweeps. Now, a liquidity sweep is where a bank has swept liquidity to then fuel all of their orders. So let's go onto the chart so I can then explain this visually as a concept. Okay, so we are on the chart. So how do we see banks' signatures? So first of all, if banks need to fill orders, so banks need to fill orders. So let's say a bank like HSBC has been tasked, or this morning they need to buy or convert, let's say $1 million into 1 million euros. So in the morning, bank needs to convert $1 million into 1 million euros. So obviously how they're going to do that is they are going to trade and they're going to convert that, and that involves trading Euro USD. So as you see, the market we're on is Euro USD in the top corner. So they need to trade Euro USD to convert dollars into euros and also euros into dollars. But let's say a billionaire has asked a bank to convert $1 million into 1 million euros. So obviously they're going to trade Euro USD. So how they're going to trade Euro USD is they are just going to trade it and fill orders. So trade it to fill orders. But are they going to be able to just get $1 million filled straight away? Because to buy, you need someone to sell to you, and vice versa. So for the bank to trade $1 million of Euro USD, and let's say they want to buy, so they're buying Euro USD, they need somebody to sell to them. So they're going to need somebody or somewhere in the market that is currently selling $1 million of Euro USD. Now, this is going to be unlikely at one given point that there's just $1 million of liquidity just floating in the market at one time. Now, this is all hypothetical. There might be much more liquidity than this, so this could be 1 billion, 1 trillion, something like this. But they're not going to be able to sell $1 million at a given price. So what they're going to need to do is they're going to need to trigger a bunch of liquidity to then use to fill their orders. So let's just go and do some basic forex trading or some basic trading knowledge. When you buy, okay, and you go for a long position, what is your stop loss going to be? So your stop loss, okay, let's say we draw a long position out here, our stop loss is going to be a sell. So if we get stopped out of our trade and it was a long position, that triggers a sell. So let's say we buy one lot, so we buy it. If price then comes up or comes down and triggers our stop loss, we are now selling one lot. So at this given price down here, we are selling a lot because we get stopped out of our trade. So if banks need to buy, they need to buy $1 million of Euro USD. They need somebody to sell them $1 million. So they need somebody to sell $1 million of Euro USD to them. So the best place for them to get all this liquidity for people to then sell to them, they're going to need to trigger $1 million of liquidity of stop losses, because the most apparent area of liquidity, so where price and liquidity is going to be most common, is where traders put their stop losses. So let's just use a visual demonstration, didn't mean to open that link, of where this could be. So let's just picture simple consolidation, support and resistance like so. At the top you have resistance and at the bottom you have support. Traders who are then trading this, they're going to be selling at the top and at their short positions, okay, and they're going to be buying at support with for their long positions. So when traders trade support and resistance, when they buy at support, their stop losses are going to be under the support area. So that means there are stop losses under support, and also they are going to be selling at resistance, which means their stop losses are going to be above resistance. So there are stops up here as well. So in the middle of these ranges, let's say if we pick this point, there isn't going to be much trading or much volumes. There's going to be no volume in this area here. Why? Because why would somebody trade kind of in the middle of a range, just buying or selling here randomly? Because it's in the middle. It's not support, it's not resistance, it's just lying somewhere in the middle of a range. So not much volume is going to be in this zone. But if you get to, let's say, this support zone down here, people are going to be buying here. Why? Because people see it's a previous support zone and they think price is going to bounce again and continue the consolidation. So when people are selling, their stop losses are going to be under this area, and this means that under this area with the stop losses, there is going to be lots of resting liquidity. So let's say there were 10 people trading in this area here, and there's 100 people trading in this area here, there's going to be 10 times more liquidity under this level at this point than there is somewhere down here. So there is a lot more liquidity under or above a range than there is in the middle of it. So this liquidity above and below a range is called external liquidity. Now, this concept of liquidity, I go more in depth in my full liquidity guide. So if you're not really understanding, you can go watch that full course first. But this is just the basics of liquidity, and hopefully you know what I'm talking about. And if you don't, then go watch my full liquidity guide, and I will explain a lot more of this in a lot more of detail. So because And let's say in our example, they wanted to buy $1 million of Euro USD. They need somebody or the charts or the price to sell them $1 million of Euro USD. So the best way to get somebody to sell you is by triggering their stop loss. Because if they push price below this zone and they trigger all of these stop losses, every single person who went for a long in this area has their stop losses under this area. So under this area, all of the let me do this again. All of the sell positions, because when you go long, like I said before, your sell is your stop loss and your stop loss is going to be selling. So all of the sell positions are in this area down here. So if the banks come into price at, let's say, here, so the banks are looking to sell or buy, sorry, they're looking to buy $1 million of Euro USD, they're going to wait and they're going to trigger all of the stop losses, so then all of the sell positions get triggered. So then once all the sells get triggered, they can then go for their buys. So at this point down here, they have triggered stop losses. Okay, this means that they've triggered a lot of sell positions, which means they can then use these sell positions to trigger all of their buy positions. So that is pretty much the concept of liquidity sweeps, because they are looking to trigger stop losses so that they can fill all of their buy positions from the sell positions of the traders who are trading the support and resistance. So the banks have gone from not being able to fill $1 million of their buy in the middle of this range to then triggering stop losses to then fuel the markets to then trigger a bunch of sell positions to then fill their long positions. And this is the whole concept is called manipulation. And that is what all of this is. This is manipulation. When the banks artificially move price so that they can stop people out, okay, sweep the liquidity to then fill all of their positions. Now, at this point, right here, where we see stop losses being triggered and we see manipulation, this is when we trade, okay? We only trade once we see manipulation. So that is the entire basis of this strategy. Because once, let's say, price is just consolidating in this range again, and price comes down and sweeps all this liquidity down here under this low, and they trigger, all of a sudden they're triggering $1 million of buys. Once a bank triggers $1 million of buys at a single point of price, that price is just going to absolutely shoot up because of the severe amount of orders in that market. There are going to be so much more liquidity of buys than there is sells, and when there's more buyers and sellers, price goes up. So we need to be able to spot this area down here, that this is happening, so we are then able to predict this massive move up, so then we can then catch this massive move up ourselves and use this to make us money. So the entire basis of our strategy, why we are trading like this, is because we want to scalp and we want to catch high volume. The only way higher volume happens is if banks are trading. And when banks are trading, they leave signatures like this liquidity sweep that shows that the banks are going to actually about to put a absolute crap ton of orders into the market. And once we see this signature, we then quickly go for our trade and wait for their massive amounts of buys to be filled, so then we can then catch this. So what makes this strategy difficult is the banks know that this exists. They know they have to then artificially move price and sweep liquidity to then fill their orders. But if they make it that obvious, then all the people, and they see this liquidity sweep, they're going to start buying up this area before the banks can, because they know that this is probably going to be a bank move. So the banks aren't going to be able to fill all of their orders because they know people are going to be trying to predict them. So how they counter people predicting them is sometimes when they break out of and they form a liquidity sweep, they just continue pushing price down. So everybody, let's say like me in this scenario with my position here, would have gotten stopped out and we would have lost money. So this is how the banks are able to counter people predicting them, is sometimes and randomly they just, instead of pushing price up, they push price lower and lower and lower, trigger all these stop losses, and all on top of all the stops you had from trading support and resistance below this low, they also can then fill all of the stops below all of the people predicting the bank's move. So they now have both of these stop losses triggered so they can fill more orders and then push price up. So again, how do we counter this? Well, we need to use our trading expertise and intuition to try and figure out when banks are going to push straight up on a liquidity sweep, or if banks are going to sweep liquidity, fake a move up, continue lower, trigger more stop losses, and then push price up even higher again in the future. So we don't want to be the people entering up here. We want to be the people entering for a long position down here. Now, this isn't easy to spot, and you are going to get it wrong some of the time, and that is just inevitable with trading. No one's got a 100% win rate. You have to take some losses because the banks aren't just going to be 100% predictable all the time. But we need just to be right more than we are wrong. The whole reason that we have more confluences than just a liquidity sweep in my strategy is to then be able to hopefully predict with a bit of accuracy when this is going to happen or when the down move is going to happen. So later on in this full strategy course, when I will go through all my different confluences and how I use them in harmony together across all the different time frames, that is all because we need to predict when the banks are going to fake us out or when banks are just going to do what they normally do. So to recap all of this knowledge, banks need to fill orders. So banks need to fill orders, and they can't do this normally in any random point in price. Okay, so they need to trigger orders so they can fill their orders. So that involves sweeping liquidity and triggering people's stop losses. So banks need to fill orders, they can't. So how do they do that? If they trigger people's stop losses, that fuels their orders, and that means they can then fill all of their orders and successfully buy their, in this example, $1 million of Euro USD, and they've converted it. Now, also, it's not just about converting dollars or converting money and just filling orders. The banks, when you're trading with $1 million, the price they buy at matters as well. So if, let's say, price is moving in a range like so, and then price breaks out of this range and they trigger stop losses below this area, they have the opportunity to buy down here. So let's say instead of filling their orders up here, they're filling their orders down here. So this saves them money because if you buy up here, you'd be buying at a higher price than you'd be buying down here. So let's say you wanted to buy a carton of grapes and the carton of grapes cost £3 or $3 when they're up here. Let's say price goes on a sale and now the grapes cost $2.50, like so. If you buy down here compared to up here, you save 50 cents or 50p, whatever currency we're trading in, on your pallet of grapes, which is great. Everybody wants to save money. Also, if price was to push lower down here, like so, and you were to buy grapes down here, you could be buying grapes for $2, which is much better than buying it for $3. Now imagine you wanted to buy 1,000 grapes. If you're going to buy 1,000 grapes at this price, you'd spend $3,000. But if you were to buy 1,000 pallets of grapes at this price down here, you'd be buying $1,000 of grapes, 1,000 pallets of grapes for only $2,000. So you would save, between these two areas, you would save $1,000 on grapes. This is the exact same concept for banks. Banks, if they want to buy $1 million, they don't want to buy up here at a premium, they're going to want to buy somewhere down here. So this is where the whole concept of buy low, sell high comes in. So how do we use this to fuel our strategy? Across here, we said we need to distinguish whether or not price is going to bounce here and go up, or price is going to bounce, fake us out and come lower. Now, obviously, the banks would rather buy down here than up there. So we're going to think, okay, price is always going to fake us out and come back down here. Now, again, that is too predictable, and the banks don't want to be predictable. So we need to keep this in mind based on we need to be buying at a discount down here. Let's say our discount of $2, then buying at a premium of $3. So we need to make sure we're buying low and selling high. So when we see price come down here and form a liquidity sweep, we need to be wary. Is this a discount? Or is this a premium? Or is this just our $2.50 area? Our area in the middle, which would be good to buy price. It'd be a nice 50-cent discount, but price could push lower and we could buy even more at a discount. So this is another area of the market that's difficult, and it's also something that we need to understand to trade our strategy, is to be able to distinguish whether or not price is at a premium, a middle area, kind of like a fair price area, or at a discount area down here. Now, later on in this strategy, we can use tools such as the Fibonacci tool to distinguish the ratio that price is at, if it's at a 50% retracement, a 79% retracement, and we can use confluences like this to figure out whether or not we're at a premium or a discount or a fair price, because we never want to be buying at a premium and we always want to be buying at a discount. So yeah, that is what I will be teaching later on in this full video course. But other than that, I really hope you guys can understand how the banks move, or how the markets move, by banks needing to fill orders. And when they fill orders, they need to then trigger stop losses to then fill these orders. But they want to be buying at a discount to save a lot of money, to get the best exchange rate possible. So it's all about these concepts, and you can look at my recap, understand it, write it down, learn it off by heart, so you can fully understand how this strategy works. But yeah, I'll see you guys in the next video, and I hope you guys understand how my strategy works and why I trade it.